Why do 90% of lottery winners go broke within 5 years? Why do doctors and lawyers earning $500,000 per year still live paycheck to paycheck? And why do some high school dropouts retire by 40? The answer isn't luck, talent, or even hard work. It's financial literacy. In this video, we're tearing into Robert Kiyosaki's Rich Dad Poor Dad, the book that sold 40 million copies by exposing the lies we're taught about money. If you're ready to stop trading time for dollars and start building generational wealth, this is your blueprint. Let's dive in. Robert Kiyosaki grew up with two father figures. 1. Poor dad. His biological father, a PhD-educated teacher who preached, go to school, get a job, save money. 2. Rich dad. His best friend's father, an 8th grade dropout who built a real estate empire and said, don't work for money, make money work for you. This book isn't a memoir. It's a clash of ideologies. Kiyosaki argues that schools teach us to be employees, not investors, trapping us in the rat race. Let's dissect the 3 pillars of his philosophy. Kiyosaki's core lesson: the rich by assets, the poor by liabilities. Assets: put money in your pocket, rental properties, stocks, businesses. Liabilities: take money out, cars, mortgages, credit card debt. Interactive exercise. 1. List your current assets and liabilities. 2. Calculate your monthly cash flow, income, expenses. 3. Ask, is this item funding my freedom or chaining me to work? Kiyosaki's rule: if it doesn't generate income, it's a liability. Meet John and Sarah. Income: $120,000 per year. Expenses: $110,000 per year, mortgage, car loans, credit cards. Savings: $10,000 per year. They think they're safe until a layoff or medical emergency wipes their savings. This is the rat race. Work, earn, spend, repeat. Why it fails: no passive income. Trading time for money caps earnings. Taxes: employees pay the highest tax rates. The rich use corporations to pay less. Inflation: cash under your mattress loses 2 to 3% value yearly. Kiyosaki's escape plan: 1. Upskill. Learn accounting, investing, and market trends. 2. Start small. Buy a dividend stock or rent out a spare room. 3. Reinvest. Use profits to acquire more assets. Real-world success: Pat Flynn, smart passive income, built a $3 million per year blog by monetizing his expertise. Graham Stephan, retired at 26 with rental properties and YouTube ad revenue. Kiyosaki's Cashflow Quadrant explains how people earn money. 1. Employee security over freedom, e.g., teachers, nurses. 2. Self-employed traders of time, e.g., freelancers, small biz owners. 3. Business owners, systems generate income, e.g., Elon Musk, Sarah Blakely. 4. Investor, money works for them, e.g., Warren Buffett, real estate moguls. How to shift quadrants, E/SB. Build systems, e.g., hire a team, automate tasks. Reinvest profits into assets, e.g., stocks, rental properties. Case study: Arnold Schwarzenegger, shifted from E, bodybuilder, B, fitness empire, I, real estate, stocks. Exercise: which quadrant are you in? What's one step you can take to move right? E.g., start a side hustle, buy a REI. Kiyosaki shreds traditional money myths. 1. Go to school, get a job. Schools teach compliance, not creativity. Example: Steve Jobs, dropout, versus Kodak executives, PhDs who missed the digital camera revolution. 2. Save 10% of your income. Savings accounts yield 0.5% interest. Inflation erodes them. Instead, invest in assets. 3. Avoid debt. Good debt, e.g., mortgages for rental properties, leverages OPM, other people's money. 4. Diversify investments. Kiyosaki says focus, then diversify. Example: Warren Buffett's 90% wealth from 10 investments. Critical take: Kiyosaki's advice is risky for risk-averse people. Pair his ideas with Ramit Sethi's I Will Teach You to Be Rich for balance. My journey with Rich Dad Poor Dad. Win: sold my $30,000 car, liability. Invested in index funds, asset. Fail. Bought a cash flow positive rental property. Without checking the roof, cost $15,000 repairs. Lesson: due diligence matters. Kiyosaki's blind spots. Survivorship bias. He highlights successes, not the 90% who fail at entrepreneurship. Debt danger. Leverage can backfire. See 2008 housing crash. Advice: start small, learn continuously, and build an emergency fund first. Rich Dad Poor Dad isn't about getting rich. It's about thinking rich. Your homework. 1. Financial audit. List assets/liabilities. 2. Learn one skill: investing, copywriting, coding. 3. Buy one asset: a stock, a course, or a side hustle tool. If you're ready to escape the rat race, grab Kiyosaki's book and drop a comment. What's your first wealth building move? Don't forget to like, share, and subscribe to Chapter Trek for more life-changing book reviews. Until next time, stop working for money and make it work for you.